In the 1990s, consumer goods stocks like Coca-Cola were the big stars on the stock markets. These days, they usually stay under the radar, hardly ever making big headlines. They're considered boring. But boring is good, especially when the company is profitably growing. Such stocks tend to earn investors the most in the long run. This holds true for Coca-Cola Company as well. In this video, we'll show you what makes this company strong and what investors can expect. There is no need for an introduction to the company. Coca-Cola is one of the world's most famous brands and the largest soft drink provider. Its main revenue driver is still Coca-Cola and its various flavors. However, the company offers much more. In recent years, it has significantly expanded its business with many bolt-on acquisitions. Alongside the traditional Cokes and sparkling flavors, it now also offers drinks in categories like energy drinks, juice or plant-based water, and even hot beverages. The portfolio includes brands like Fanta, Schweppes, Sprite, Fuse Tea, Costa Coffee, and distribution partnerships with companies like the energy drink maker Monster. Overall, the corporation owns more than 200 brands. The stock price has had a turbulent history. The shares belong to the big stars in the 1990s, driven in part by Warren Buffett's 7% stake in 1988. Which saw the stock price increase tenfold by its peak in July 1998. With a P/E ratio of over 70 at that time, the stocks were hopelessly overvalued. As a consequence, a massive correction took place. Although there were no real fundamental problems and the company increased its dividends every year, the stocks lost nearly 60%, and it took 16 years to reach the previous high. The stocks were no longer in the spotlight. The new stars were now Facebook, Amazon, Google, and Apple. However, Coca-Cola Company has always delivered. Overall profits have significantly increased to date, and the progressive dividend policy has been consistently applied. The massive overvaluation was adjusted, and today the stocks are fairly priced, trading slightly below their historical average valuation range. The company has decades of experience with successful global growth. They have never pursued foolish large acquisitions. Instead, they have opted for smaller ones that can be easily integrated into the existing portfolio. Their total addressable market is $1.3 trillion, while their revenue stands at $45 billion. So there is ample room for growth. They have set explicit long-term growth targets to guide investors: 4 to 6% revenue growth, 6 to 8% operational profit growth, and 7 to 9% earnings per share growth. Of course, there's no guarantee that these targets will be met. However, if the past is any indication, there's a good chance that earnings will grow within these ranges over the long term. The stock meets the two main criteria for a successful long-term investment. It is fairly valued and the company has well-founded growth potential. The total return over the last 5 years was about 50%. It primarily consists of dividend yield and earnings growth. If the company continues to meet its targets and there are no dramatic changes in the interest rate environment, shareholders can expect similar total returns in the future. However, if interest rates rise in the medium term or if Coca-Cola significantly misses its targets, the stock price will temporarily come under pressure. In such a scenario, shareholders will at least continue to receive dividends. These are very unlikely to be cut, considering they have been increased annually for the past 62 years. With a current yield of 3%, this is a significant consolation in tough times. Thanks for watching. If you liked this video, give it a thumbs up and don't forget to subscribe for more content just like this. See you next time. The content provided on this YouTube channel regarding dividend stocks is for educational and informational purposes only. It is not intended as investment advice, nor is it a recommendation to buy or sell any particular security or investment.